I think we've heard today there's a tremendous amount of capital out there. It's going after a lot of deals. Do you think we're in a good place that there's so much capital out there, or is it a little like a good vineyard that the more it struggles, the better the wine is? What do you think? Weigh in on it. Too much money? What do you think?
No, I think you just look at the underlying industries. I mean, there's so much room for innovation. You're talking about the largest asset class on the planet, on the owned real estate side. Then you take $1 trillion of construction in the U.S. We're early in the space. It's good that capital is coming in. The more capital, the space has, the better right now. And I think, it feels big because there was nothing, 7 or 8 years ago. Now we're in the third inning, so we're happy to see it coming in.
So Brad, you talk about maybe this is the VC for the industry. The R&D for the industry. This tremendous amount of money going in. Do you find that you're having trouble deploying capital? Are you having trouble finding places to put it?
No, we're not, and it's actually just the opposite. The amount of deal flow I think all of us are seeing is just continuing to ratchet upwards, as the entrepreneurial community also understands that, as Travis mentioned, this is the largest asset class on the planet. So everything within that can be digitized and improved upon. So, but interestingly enough, it's not that it's too much capital, but the right capital needs to be deployed, educated capital. And I think that's what you have sitting here on this stage, where people that actually understand real estate, come from the real estate world, understand how it manifests, and can be deployed responsibly and to create a venture return.
Any other comments on that?
I mean, I'll put a finer point on it. Is sort of technology ceases to be an industry unto itself and starts to reflect the industries that it serves. Real estate tech should be one of the largest, if not the largest, technology industry in the world, premised on the baseline of the asset being the largest in the world. So it's the white space we all saw. It's why we all focused on it initially, and I think that thesis is starting to prove true. This is proving not to be a fad. This is the evolution of our space, and it's my humble opinion, in 10 to 15 years, there's going to be no discernible difference between a real estate and a technology organization. You have to be both, or you'll be losing out to your tech-enabled competitor.
Yeah, and the fact that I guess 4 or 5 of us are backed by industry operators that have put their money where their mouth is, so to speak, tells you where the industry is at this stage, and they're all ready to start deploying technology fairly broadly through their portfolios.
Look who was on stage before us. I mean, Brookfield, Hines,
right.
RXR. These are industry leaders, and they're talking about tech.
And that wasn't the case 3-4 years ago when Pierce and I first met, and when Michael met and the Center started following this stuff 5 years ago. Nobody was talking about this, and I think some of the traditional VCs were dancing on the edges a little bit. There was nothing focused, and it certainly wasn't strategic. Would that be safe to say?
It's certainly safe to say for Index. I mean, what we've seen is some of the smart investors move into the category. And what we're looking for as generalists is large opportunities, industries that are moving from offline to online. You'd be hard pressed to find a bigger opportunity than real estate. So for us, there's a lot of symbiosis between the funds that specifically focus on real estate and the generalist funds.
So Index is, I know you're focused on CREtech or REtech, but Index has been around a long time. How many years?
So we've been around for about 25 years. We have done some real estate investments, over that time frame, but we're really starting to ramp up. So it's exciting to be here to see the energy, to walk the floor and see, the different pockets of innovation.
And Travis, Navitas is how old?
2011.
2011, Jeff?
2008.
2008. So one of the oldest. I didn't know Index was, but real estate tech more recently, right? And John, you're not new to the game because you've been doing this a while, but
yeah, our final close was 6 weeks ago.
6 months ago.
We started fundraising a year ago, but I guess we're the newest kid on the block.
And Brad, 2 years?
2 years.
Yeah, 2 years. So this is quite a spread, but I think this focus, certainly we've seen it, was much more recent, even though you guys have been around a long time. So mentioning that, and we'll come back to RETV because I want to hear a little bit more about that, but mentioning Index, what we noticed is this was a US phenomenon 3-4 years ago, 5 years ago. Most of the startups were here, and then other countries started coming into it. What are you guys seeing from an international, either capital coming from overseas, deploying, presumably your strategic partners are global, so they're going to start deploying overseas. Tell us a little bit about the US versus non-US scenario. Anybody can jump in. I think all of you probably have something to tell us.
I mean, I'm happy to kick it off because we're a transatlantic fund, and I use the word transatlantic instead of global because we're not in China, and I don't think you can call yourself global unless you have a presence in China. But it's true. I think it's really where the opportunity is going to be in the next 5 to 10 years. But the way that we think about it is we're looking for really big opportunities that can span both, the U.S. and Western Europe. And so for us, whether a company's coming out of the U.S. or coming out of, the U.K. or France or the Netherlands, we're looking for opportunities that have technology implications that will be broadly applicable. So it really doesn't matter what specific geography a company is coming out of. We're looking for businesses that have high ceilings that can create multi-billion-dollar businesses. That's what we're looking for.
Right. I mean, much like John, Travis, and Brad, all of our LPs are real estate developers, owners, and managers. And so we're looking for technology companies. We're geographically agnostic, but as long as they're serving the locations where the properties are located, we'll look at it.
Yeah, I'd say, I spent the last 4 years in Germany doing venture in Europe and did 2 proptech deals over there, in fact. And it's amazing since we've announced all the European companies actually contacting us because they want to come to the U.S. So I think it's to Jeff's point, it's where the assets are located and if the companies can serve them. We specifically have a global mandate. And our LPs, some of whom are looking at expanding to Europe, are looking for solutions that operate in Europe as well. Interestingly enough also though, do you find that the European companies have lower valuations or valuation expectations than the ones like here in New York or definitely in San Francisco?
They're better dressed. I'm not sure about the valuations, but definitely classier.
Lower valuations or lower expectations?
Lower expectations on valuations.
Yeah, definitely.
Thank you for the clarification.
Yeah, no, just curious. So are we seeing we see U.S. companies trying to deploy in other countries, but we've seen Equium migrate to New York. We've seen Okapi, I think, migrated to New York. Maybe Cretify. Some of the startups have recognizing they need to be in New York. Are we going to see more of that? Is this the place to be, or is the opportunity going global?
Well, I think I'm the only New Yorker here. I mean, there's a reason for the concentration here in New York. We have look at the volume of opportunity around. But I think any global city is going to become a magnet for innovation. I mean, you've got Los Angeles, obviously San Francisco. San Francisco, from a volume perspective, the square footage might not be that big, but as far as innovation, it's second to none.
It seems like there's a bit of a flywheel in New York. I would say that it's different than other cities. I mean, being in LA, it's a huge market, but there's innovation taking place and there's owners that are interested, but there isn't the same kind of community that's here. So I think that we're seeing a lot of that momentum kind of just spill over here in this city. But I mean, the U.S. as a whole, we're an entrepreneurial country. So it's like the early adopters, it's an innovative place. So I think it's a good market for startups to get their legs.
Yeah, and Travis hit the nail on the head. I think international investors and property owners are, I think, looking to the U.S. to identify trends early in the innovation cycle and take advantage of those in their own markets. I think the U.S. right now is leading in the majority of the prop tech space, but make no mistake, there are very interesting technologies that are germane to those local regions overseas that I think are surpassing the U.S.'s ability, specifically around AI, data analytics, facial recognition, a whole host of other interesting innovations that I think have mass applicability to real estate. And to the point earlier around many of these LPs have global portfolios, I think the advice that you give and the investments that you make have to have a global slant to them, because without it, I think you're going to be missing in very important pieces of the innovation economy. And we're really keen on having a global perspective as opposed to a local one.
Hey, John, you mentioned you have an international mandate, but not every country has single owner multifamily structures.
Correct.
Right? So you'll just focus on I mean, there are plenty of countries to go around, but it is interesting, right?
Yeah, I mean, we're predominantly focused on North America, but Europe, you've got a lot of privatization happening in Europe right now, and some of the big U.S. REITs are looking over to Europe to take advantage of that. So there are opportunities in Europe, but no, we're predominantly focused on the U.S. And I guess I would say New York really, I think, is the epicenter, at least for real estate tech in the U.S., but I draw a difference between what we're calling rent tech and commercial real estate tech. I think New York is the CREtech capital. We're looking at rent tech companies all over the country. It's highly diffused. I mean, one of the biggest apartment markets in the U.S. is Dallas, right? I mean, if we look at our portfolio of our 925,000 units, the single biggest market for our LPs, over 50,000 units, is in Dallas. And we're looking at investment right now at a company based in Dallas. In other big markets, Phoenix, we have a portfolio company in Phoenix. So our portfolio and the deals we're seeing are really spread across the country. And a lot of them are based in big apartment markets, which tend to be Sunbelt, the big institutional apartment markets, which tend to be Sunbelt cities.
Brad, you mentioned the different techs. How do you guys look at this? Does it matter whether it's construction tech, real estate tech, legal tech, fintech? Because we know that they all are overlapping and frankly, they're converging. Does it matter when you're looking?
It matters a lot. It matters a lot. I mean, these markets we're grouping it all together in a way to broaden the theme and make it more interesting. But each of these underlying markets has different customers in a lot of cases, different market dynamics, different adoption cycles. And I think it's important as an investor and people in the room to understand, depending on what market you're going after, it's a whole set of different considerations.
So a startup that does, debt or does lending for construction lending, is that fintech? Is that construction tech, or is that?
I mean, it's blending, right? Yeah. To that point, right?
Yeah, I was just curious to know.
It is starting to blend together. I mean, talking to Mark, right? He covers fintech and real estate tech at Index, and you're seeing that a lot. I think in the big generalist funds of what's fintech maybe a few years ahead of real estate tech in a lot of ways, but now real estate tech is starting to grow out of that. You probably comment on that more.
No, it's interesting, I didn't realize you guys were having a specific retail kind of focus. I mean, what we're seeing from the generalist perspective is all the categories start to bleed together. We've done a few deals in autonomous vehicles, and you can see huge real estate implications there. So I think that to try and say, built world is construction or it has to be, I think the labels are going to be somewhat meaningless a few years from now as everything bleeds together.
Yeah, and our partners don't make that distinction because they're involved in all of it. So again, if you're trying to give advice across a broad spectrum, you have to have expertise across a broad spectrum. A great example, it just got announced about an hour ago, but one of our portfolio companies, States Title, which is an innovative title insurance organization, just merged with one of our LPs' captive title company, North American, the 6th largest title provider in the US. This is one of the first examples of a minnow and a whale getting together and leveraging each other's strengths to go from tech-enabled to now, in a few markets, to tech-enabled in every state, leveraging the incumbent advantages, but partnered with technology that can accelerate the business in a real and interesting way. And again, the advice around that merger consideration stem from a really great understanding of the innovation occurring in the fintech ecosystem. But if we didn't have that expertise or didn't have that opinion, that merger would have never happened, and I think the industry would still not be in a position to evolve. And with this merger announcement, that evolution is taking place in real time.
So I think it's also, let's just say, even on the real estate side, right? Hospitality now and multifamily are starting to blend, office is starting to blend. And digital and physical are coming together, different asset classes are starting to look like each other. And that's also happening even at the innovation level too. So.
Student housing or just traditional multifamily?
No, student housing, senior housing, multifamily, single-family rentals.
Okay, so
It.
not just traditional.
And I would say that's the one difference, right? And probably because of our LP group, we're very focused operationally on technologies that help them better operate their portfolios. And multifamily really is its own category within real estate. It's lumped in with commercial real estate, but we see, at least in our sector, companies that are specifically focused on our industry. If they're selling something that's operational, I agree, fintech, construction tech, that cuts across all sectors. Right. But as soon as you start getting operational, companies tend to focus in at least the multifamily, single-family rental space because it's the only industry where you're dealing with both B2B and B2C.
Right. Brad, springing on your idea, we're at a stage in the cycle where Comfy got acquired by Siemens. You just announced this acquisition. Early on we had the VTS Hightower arrangement, the different configurations, acquisitions, mergers, and consolidation. Where are we, and what are some examples that you're seeing that I've missed? I just named a few of them.
So one of our early portfolio companies called Red IQ, which was in the commercial loan space, got acquired by Berkadia. And that was one of the early ones. And I think you're going to start seeing the pace quicken as some of the larger companies, as specifically as what Brad just said, the whales look at the minnows and say, we can just own this. And we can now create a distribution strategy that can grow them. If they're in one state, we can grow them to 50 states. So I think it's just starting to really to really happen, but it's going to snowball, I think.
But there's a distinction. There's the CBRE acquisition of Floored versus an end user making an acquisition. I think they're distinct. There's a tech consolidation and then there's a user consolidation. Any other example?
I mean,
I didn't mean to interrupt.
For the last few panels, the last couple of years, right, it's always been, that's been kind of the knock on our space. It's like, where are the exits? Like at some point, like a lot of hype, a lot of talk, a lot of capital coming in, where are the exits? So we were fortunate. We had a big one a couple weeks ago with PlanGrid that got bought by Autodesk, and that was in the construction tech sector, but it's a mobile SaaS business. So we need more of those, but it's early. But there are some great private companies that at some point here will start to hit, and really, I think when that happens, put this whole space on another level, but we're very early in that process.
PlanGrid, Autodesk?
PlanGrid got acquired by Autodesk.
For those of you who didn't know, PlanGrid got acquired by Autodesk.
Well, and I think what you're starting to see now is that you're starting to see these early stage companies reach like sort of functional adolescence or early adulthood for the first time, and they now have the scale and the customers and the data to do those types of consolidation plays. I mean, I think VTS is a great example. Like VTS is now established as the winner in that space. It took a while for those companies to sort of reveal themselves. I think Honest Buildings is doing something similar. Now we have a clear view of what the world's starting to look like, and I think owners, operators, users, customers can now feel confident and comfortable that consolidation is going to provide them something that enhances that experience in ways that an earlier stage company can't do. And I think with strategic support, I think the products that they're going to continue to build are going to be increasingly interesting moving forward. And that's what I think we're all looking forward to is an evolution of the space to more functional maturity that I think will increase the investment opportunity as well.
All good, but do we squash innovation and ideas? The kind of the Clayton Christensen issue where go to a big company and you stop being creative? Comments?
Well, yeah, I'd like to see more consolidation within the industry. I mean, in multifamily, for example, you've got one of the incumbents, RealPage, that's made over 60 acquisitions in the last 5 years. And they just keep grabbing all the point solutions. There's still, I think, to Trevor's point, it's the second or third inning, and most of the companies out there are still point solutions, but they're starting to mature, like VTS, to the point where they can start rolling up their own category. And that's when I think we'll see some real viable, pure tech options for the owner-operators out there.
Yeah, and just to go back to the States Title example, States Title is being run, the new CEO of that combined merger acquisition is the CEO of States Title. The technology CEO is going to be running that organization. And there's a recognition from Lennar that is the reason why that merger makes sense, is that the technology is going to drive that combined entity forward, because that's the evolution that they're relying on to innovate the industry.
I think that might be an inflection point too, because
exactly.
that was not the case with Red IQ and Bricadia.
Yeah.
They said, "Oh, this is cute. We're going to take it. We'll swallow it. We'll use it." But that's
that's great.
The technology at the leading edge, and then you'll see the waterfall really start.
So this is where the minnow is now in charge.
Yes. Yeah. But again, it's not. That's the thing that I think the problem is. It's like it's distinguishing the two. Like that's always been the issue. Now it's a function of let's look at this technology tool to empower this to generate synergies that haven't existed before, to create customer service that hasn't existed before. And I think it's a recognition of what you do well and what we do well, and having an honest discussion about that, as opposed to just assuming that we can do this better because we've always been able to, and understanding that this tech ecosystem that's evolving and the $12 billion of R&D that's been going on is resulting in both innovation and leaders that can take this thing to the next level.
Right. And I think the M&A is fantastic for the industry, and I mean, amazing companies, States Title and PlanGrid, and great acquisitions. When I look towards the 5th, 6th, 7th innings, and what we're betting on is the independent winners. So the companies that can break free, and we're looking for companies that ultimately can become public. So it's, I think this is a great evolution in the industry, but that's ultimately, I think, the direction we're on stage 5 years from now. What we'll be talking about is the next set of public companies in this space.
So what do you think? Are IPOs dead? Is that even an exit strategy anymore?
Yeah, no, it's definitely a strategy. I think it's just it takes time, right? You got to have scale, and the space is still fairly nascent, right? So there's companies that are on a path to get there. Like Mark was saying, it's just we're a couple years away from that, which would be great for.
Well, it's early. It's hard to tell. We know that the IPO landscape is not the same it was last time around. Generally.
Just in general, right? In venture, companies are staying private longer. They don't have to go public. A lot of companies don't want to go public. There's lots of liquidity options even in staying in the private markets more so than ever,
Yeah.
right? Later stage funds are coming in and buying out early investors' positions.
And the valuations in the private markets.
Right, and the valuations in the private markets are like nothing we've seen. So the need to go public isn't there like it used to be, but it would be a great thing if that did happen at some point.
Yeah, it's not that they don't want to go public. It's that they don't want to go public. It's not that they can't go public. Yeah. And there's just so much capital at the later stages.
What we didn't mention was a couple of the recent failures. So we're talking about, all the good, the upside, Realty Shares, Homey, some of the other ones. What's that tell us? Obviously that's part of the cycle. Are you surprised we haven't seen more of them sooner? Partly because of the capital. Thoughts on failures?
So I'd say with any failure, right? I think there's an easy rush to "I told you so" or like a condemnation of the space, right? Like, oh, I knew that wasn't going to work, and and I think the incumbents sometimes really struggle from that. The way I would frame it is that view it as a data point, and make no mistake, just because Realty Shares struggled to articulate their business model doesn't mean that their business model doesn't work. And the next crowdfunding or the next blockchain or next crypto or next whatever that iteration looks like is going to look at the information and the output and the data that Realty Shares generated to refine the business for the next iteration. And venture capital is going to be sitting there waiting to fund it again and again and again. So it's more of a opportunity. Like, use it as an opportunity to learn, but don't assume that just means that innovation will never take place.
Fair enough.
And failure is part of our business model. In any given fund from index, more than half the companies won't succeed. And that's okay. That's what we're looking for. And so I actually think that in CREtech and real estate tech in general, there has to be a broader aperture, a larger willingness to experiment, to fail, because some of our best returns have been founders who tried once, twice, 3 times, and then broke through after that.
There haven't been a lot of them.
That's such a great point. Sorry, I just have to jump on that one too. Our industry, real estate is not a business that you fail in, right? So real estate investors, the risk appetite is fundamentally different than the venture side, and it's almost it's a big knock to say, oh, I lost my capital in that deal. On the venture side, if you're not losing on deals, then you're not taking enough risk, and that's something that as these two worlds start to collide more, there needs to be an openness and an acceptance to really kind of get this right.
Well, I think you can lose a lot of money in real estate. Look at the downturns. If you're levered too high, I think though because our fund has a fundamentally different view than you at Index. We don't want to lose. We're specifically investing to our LPs capacity, and I think as sector specific VCs, we'd like to have a lower loss ratio than a higher loss ratio, especially if, as all of us on the panel are deploying technology to our LPs, it's not just the money that we lose, but it's also the operational inefficiencies and upheaval that we bring if these companies fail. For Realty Shares had a lot of press, but there are other companies in the space that are thriving. Our portfolio company Fundrise raised once, and they're doing a phenomenal job. And I think that goes back to something that we all look for and can all agree on, which is we invest in founders. It's the space, like what we're looking at. Real estate is not a very difficult asset class to understand. Specific markets might be, but it's the type of people who we're investing in. And like Mark said, you might have an entrepreneur who failed once, failed twice, failed 3 times, but there's something about him or her that says, eventually this person is going to stumble on something. In real estate, there's no bigger opportunity on the planet to actually have that come to fruition.
Yeah, I'd echo Jeff's comment. We as industry-focused VCs, where our LPs are also the customers of the company, we like to think that we'll have a lower loss ratio and help our company succeed. We've got one investment that we've taken from 0 to 10 million in revenues in 6 months, and it's all on the backs of our LPs doing business with the company. And that's something that the industry guys that's what we bring to the table.
0 to 10 million in 6 months.
Yeah, maybe 8 months.
Oh, maybe 8 million.
Yeah, 8 months.
This year.
8 months, excuse me.
This year.
Still pretty good.
Look, I think we talk, it's a fair point, right? We should be able to help de-risk the companies that we're investing in based on our knowledge of the space and our networks, and it's fundamentally like why some of our funds exist. Otherwise, the generalist funds should be doing this exclusively. But in venture, there's so many more risks that go into these deals than we want to talk about. Channel and market adoption is one thing. What about, gross margin profile, business model, management teams, competition? There's just infinitely more variables in the venture business and building operating companies than buying and owning real estate.
We thought in the progression of this in the last 5 years that, we're in an industry where the asset's built to last 200 years. It takes 10 years to build it. It depreciates over 40 years. Very different from technology. Something shifted. I don't quite know what it is, but something shifted. Your conversation is very different from a traditional VC. I think that interests were not aligned. Do you think the interests are getting more and more aligned partly because of who's funding you?
Yeah, I think there's a lot of alignment. I mean, generalist VCs traditionally have built up great networks of founders and entrepreneurs, deep experience on the technical and product side, but may not understand our space and have the customer relationships. So a lot of great deals. Just see, we're friendly, right? We're all up here. We've invested together in lots of different companies and are working together on other opportunities right now. So there's an opportunity to combine resources and again, to kind of de-risk and help make these companies successful.
So I'm going to change course just a little bit. What recently hyped technology is likely to actually impact the industry? You guys see everything that comes through the door. Let's step out into the future a little bit. What do you find interesting? What do you think is BS? What do you think? What do you think?
Well, we're very operationally focused. I mean, our investments for the most part have to impact the bottom line of an apartment building. And I would say that the one that's been percolating for a while, but I think is ready to bust wide open, is IoT in apartment properties. For the last 4 or 5 years, everybody's been trying to justify rent bumps by deploying the technology. But the costs have gotten to the point, and the use cases have gotten to the point now where a large owner can justify it purely based on operating savings. And then when they can do that, they can justify deploying the entire property. They don't have to have the tenants opt in. They can just do the whole building. And so that's an area that we've invested in, and one of our highest growth investments is deploying building-wide, access control, door locks, hubs to power that, light switches, thermostats so you can control the vacant utilities, and also leak sensors, load sensors so you know if an air compressor is about to blow, on an AC unit. And there's a lot of operating benefits that people are finally starting to realize, or loss mitigation in the case of water damage, which is a huge problem in the industry.
So you think IoT in multifamily?
Yeah, IoT in multifamily I think is going to bust wide
The latest,
open.
greatest, most interesting.
To us, yeah.
Okay, good.
If you're talking about hype, I think nothing gets more ink than blockchain
Oh,
and
man.
autonomous vehicles.
Oh, man. I thought we were going to get away without ever having. Okay. So give us your perspective on it.
Well, I do think we don't have an investment in a blockchain-backed technology yet. We are watching. I am of the opinion that blockchain is going to be transformative in a number of ways. Not least of all, I think the transaction ceremony and the way it currently works right now, where there are a number of disparate parties that have to come together, I think that's going to go away. I think blockchain is going to enable transactions to be executed much more efficiently. But I don't personally think we're there yet.
We think the technology itself as a structural infrastructure technology is very intriguing. The crypto and all that stuff is a huge distraction. As soon as that gets out of the way, we might see some progress, maybe. Other thoughts?
So I'll take it back to your original question on themes that we're excited about.
Yeah, technology.
Sure. One of which would just be the broader applications of AI and machine learning in the space. One of the areas we're looking at really heavily right now is in appraisals, automated valuations. We're really excited about a company based out of the Netherlands called GeoFi. Actually has an office here in New York that is really just automating this entire category. And anyone who's dealt with appraisals firsthand has probably seen both the inefficiencies in the process, the data applications. We have multiple, there's a lot of great companies going after this. And Travis can speak to one in his portfolio as well.
We agree, appraisal space is great. So we're competing horses in a very, very big market. That's okay. Competition is good.
No, it's an industry that needs that could be disrupted.
It does, absolutely, in so many different ways. But for us right now, I think the big theme is digital and physical convergence and software that can help facilitate that experience. And so we're seeing, and this is playing out across asset classes. We've got an investment in the office space and are also about to make one in the multifamily space. But there's a company, HQO, that's here that we're really, really excited about. And this is, taking advantage of mobile, putting that in tenants' hands and allowing them to engage and interact with their space like they haven't been able to in the past. I mean, And the space comes, as our living environments and our work environments and what we do after work start to become more ubiquitous, we want to be able to experience that through, and control it, through our mobile devices. So to be able to do that in the space and provide a revenue enhancement platform to landlords in the process, that's really, really exciting to us.
Digital, physical. Brad, I'm going to let you have the last word on that one. What
Yeah, because I agree with everything that everybody's saying here. I'll try to kind of come up with something different. I mean, we're really excited about what's happening in residential tech, specifically around our investment in Open Door. I think they've reached a trajectory now that I think is going to allow them to scale at a really incredible clip. I think the partnerships that they're starting to form with the large home builders to offer products that have never been offered to home buyers before, and really what it represents holistically in terms of creating a transaction platform with more transparency, more liquidity for what ultimately is the most important asset in the U.S. economy, to me is just wildly exciting. And so I think whether it be iBuyer or however you want to term it, I think that iBuyer ecosystem is going to spurn a whole host of other innovations in and around residential transactions, States Title, Blend, Notarize, all these companies who are allowing for a digital experience for home purchasing and selling. I think it's, like giving a speech, death in the family, and buying a home are the three most stressful things you can do. I don't know if there's any technology to solve those other two things, but for now, I think Open Door and others like it are solving a real pain point, and I think innovating in ways that are going to change the way I think we think about the residential sector.
Thanks, Brad. I think we did an outstanding job on the public speaking example that you gave. So on behalf of CREtech, Michael Beckerman, and the MIT Center for Real Estate, I'll say thank you very much for joining us today. Let's thank our panelists.
Thank you.
Thank you.